Welcome to the deep dive video update. In this video, we look at charts that I often use in the daily videos, but I'm not using them right now. And so we have to look deeper to see, can we find any clues from those particular charts? There are also some other charts that are unique just to this video. This is being prepared for Monday, March 31st. The first is just for information. I only use it in this video. It's a long-term range of the VIX. And when we're really going down and in a bear market, we see the VIX in a higher range. Lately, we've seen the VIX in a lower range, but we're starting to go back up as the market has been under pressure. If this line goes all the way up over 20, that's going to be quite negative. Now, the VIX currently is over 20 and has spent a lot of the last week or two up around, if not above, the 20 level, but we've been able to come back down. This is a longer term range of what the VIX been doing, so we just get an idea of the overall climate. Well, since it's going up, that's somewhat negative. But as I said, if we get up into this area and stay up there for a while, that probably means that the market's already going down. Also, we look at the speed of the VIX, and I have used this quite often in and out of the daily videos. This is measured by the RSI based on 9 periods. And right now we're pretty much neutral. But what we're looking for when the VIX is really going up, that means if stocks are going down, the VIX will really go up with the RSI reading. And when we're getting more complacent or the market's going up really quickly, then we'll get a very low reading on the VIX. And sometimes this marks an exhaustion in the VIX, which sometimes can coincide with either a top or a bottom in the market. But right now we're pretty much neutral. Also, we look at another study using the VIX. This is the VIX to S&P 500 correlation. And this is going up, but we only get concerned if we go above this dashed line, which is 0. When we get up into this area, that means the market is usually nervous and usually bad things can happen at that point. Now, the market's already been going down, but we're not getting any real reading from this chart. Sometimes we can see things in this chart that maybe we're not picking up in other VIX charts or VIX studies that I do. Then we look at the VIX, and then there's the volatility of the VIX. And when the VIX is really moving, like it has been lately, this ratio goes up. And that usually means we're going down. Now, if this continues to go up, that would probably be negative in this context. This is more informational. I really don't use this in any of the daily videos. But the VIX had been coming down, but then in Friday's session with the down day, we shot back up over 20. And it it just means that the VIX is going up faster than the indicator or the volatility of the VIX is. This was in the daily videos for a couple of months. I only show this when we get up into this red area. We got a little bit close, but then we dropped down on Friday. This just is a variation of the VIX, where the VIX uses at the money options to be calculated. The skew index uses out of the money options. And when we get up into this red area, spike and then come down, that means that the market is probably anticipating some kind of a big move. Now, since they're out of the money options, they could be calls or puts. So we're not really sure of the direction. Calls go up in value as the S&P goes up, and puts go up in value as the S&P goes down. And that's why we try to see what the skew is one way or the other. And sometimes this will mark a top, a bottom, or just a continuation, but we're not getting an extreme reading currently. The Ulcer Index, this was in the daily video for quite a while. I only show it when we go above this red line, which is a moving average of the Ulcer Index. This is another type of VIX or fear gauge where it was designed for mutual funds since they only have a closing value, an NAV, that's calculated right after the market closes. And so folks that use mutual funds can look at this, and when it gets a very high reading, that usually means we're going down. And so folks might want to stay out of the market at that point. Since most mutual funds, you can only go long into those mutual funds. Where what I do in the program that we have here is we can take advantage of when the market goes up, we can take advantage when the market goes down. But since this is below the moving average, I haven't been showing that. Also, we look at the volatility of stocks with the VIX and the volatility of bonds with the MOVE index, and we see overall that red line has been going up. It's leveled off lately. That just means that stocks are more volatile than bonds right now. And this is more for informational purposes. It's hard to stick any real facts or cut and dry rules to this chart. You can see where we were kind of headed down here. Well, this red line was going up, but then other times we've been coming down with this line as we've been going up. So you can't just make it a complete, oh, we're going up, so that must mean stocks are going down. We just use this just to check the overall volatility of both markets on a ratio basis with each other. This I usually use in all the daily videos, but I stopped using it since we're below the 200-day moving average with the large cap growth ETF. I'll really only show this in case we start to go back up or if we really roll over and some of these moving averages drop below the 200-day moving average. And this one kind of comes and goes out of the daily video. This is the ratio between small caps and large caps. When this is going up, that means large caps are outperforming. Now, large caps have been going down. That would be the S&P 500. But small caps have been going down even more and are weaker. And that's why we're tending to see a higher reading with this ratio. And it's not really giving us any additional insight. So I haven't been showing this, but I'll throw it in periodically when it seems to be telling us something. This is just for information too. When we got done with the bear market that we had in October 2022, which is right down here, and started to go up, as of Friday's close, we are still up 59.6%. We've gotten a lot of those gains back, but it's still a pretty hefty gain. Then we set another significant low in October of 2023. As of Friday's close, we're still up 36% from that low. Then technical alerts, I go over these each day in the daily video, but these are the alerts for the whole week. And when we have blue or green, depending on what color you see, that is typically positive. That means good things are happening in the market. And that's what we saw earlier in the week. You start at the bottom and work your way up. Where Friday was an ugly day, so we saw nothing but red up here. So we can just kind of get a color, either confirmation or insight, just using colors by saying, oh, there's a lot of red, there's a lot of green, or it's a real mixed picture, just to give us a visual clue as to what's happening in the market. Then there are 6 indexes that I follow here, and I rank them on a scale of 0 to 100 based on their technical analysis score. And all of the indexes are not looking very good right now. But coming in first place is the Dow. Now, it's considered to be the best of the best, the blue chip stocks, because blue chips have the most value when you play poker. Excuse me. And it's actually holding up, but even it has a dismal score at 42.4. In a good solid market, this would be in the high 80s, low 90s. And so it's not doing all that good in and of itself, but it's the best looking index as of Friday's close. Second place is the S&P, which also is not very good, coming in at 29.7, a really bad score in and of itself, but it's still in second place. That's because the S&P is more balanced as far as those stocks that are in that index. It has growth, it has value, they're all large caps that are in there, but some of them balance each other out. And so when we're more under pressure, the S&P tends to hold up a little better, where when we're really going up and the growth stocks are leading the way higher, the S&P 500 will lag at those times, but it holds up better when we're going down. In third place, the QQQs. This is growth coming in at 18, under a lot of pressure right now. Then we have the mid caps coming in at 16.8. And then, believe it or not, we have the NASDAQ, which was really one of the stronger areas in 2024. It's not so strong right now. It's coming in at 14.3. And in last place with a turn me on dead man number 9 here, we have the small caps, which just are not doing good. Now they're up. They were at 6 something a week ago. Now they're at 9. So, I mean, that's a little bit of an improvement, but we're down to single digits. And that just means that their technical analysis score is very, very low. I would hesitate using this as, oh, wow, look at that low score. I'm going to go buy. I don't use it that way. I just use it as confirmation or insight with additional charts that I look at. I don't use these by themselves. This just gives us an overall idea of how this index and then all the indexes that I have in this list are actually doing compared to each other. Then in the short term, I have some short-term moving averages here going from 10 periods up to 50 periods, and that produces a rainbow. And we're down, and the lines are coming down. And we've been under these lines now since we set that all-time high back in the middle of February. And this just shows that the short-term trend is negative. And then in the intermediate term is another rainbow going from 50 periods up to 100. Also, we're below the rainbow and the lines are starting to bunch up and roll over, and that's causing some concern. The longer we stay below these lines, the more they will continue to come down, and suggesting that the intermediate term trend is negative, which that's our classification right now since we're below the 50 period moving average. So it is negative, and we're being confirmed by this. Then another thing that I'm going to be keeping an eye on if we keep going down, this just measures on a percentage basis the moves. And even after Friday's close, I have a measurement here just showing what percentage we're up. We're still up 26.49% based on this measurement here. But what I'm watching right now is when we hit a high and then keep coming down, how close are we getting to that 10% level? 10% is the definition of a correction. If we go above 10% from the all-time high, that means we're in a corrective phase of the market, and a lot of things change at that point. The whole view shifts over to something else. And we came down to that almost to that 10% level last August. And then we had a bit of a pullback here in late December going into early January. That was about 5.5%. The one over here on the right, this is what we're watching right now. Now, you're going to see that I measure things slightly different than what you might hear in the financial media. When we say, oh, the S&P is down 10%, it's in correction territory, they're basing that on close to close, where I base it on what was the intraday high when we set the all-time high, and then what was the intraday low, and we were down almost 10.5% at that point. Well, we were starting to go back up, but now we're coming back down. So if we go back and if we take out these previous lows, and keep going down lower, that's going to turn things even more negative because now we will stay in correction territory. It is a little frustrating now because usually when we come down here, we lost the 200-day moving average and then we were able to get that back. Well, now we're right back down below it again. And in a positive market, you wouldn't see that. We come down, we hit support, and then we bounce up and then keep going. This time we stalled out and now we're coming back down. And so if we do switch over and turn more negative, I'll be showing this chart more in the daily videos. Then, because we're so far below the 50 period moving averages, I haven't been showing these in the daily video, and we're clearly below them. And I use this to determine the intermediate term trend. And then the 100 period moving averages are more intermediate to even somewhat long term. And we're below those moving averages, so there's been no need to show these charts. Here, standard deviation, when we were really screaming to the downside, we were getting a very high reading here because this measures speed over the last 10 periods, not direction. And we dropped a little bit below the moving average. Now, if we keep coming down, it's going to pick up these quick moves down, and we're probably going to go back above the moving average. And then I'll start showing this in the daily video again. But since we're below the moving average right now, I haven't been showing it. This is a newer chart. It's called Landry Light, and it's not all that hard to interpret. When we're in an uptrend, you're going to see these green histogram bars going up, and they'll keep going up until something happens to change things. And we started over with a new uptrend, and then it ended. And we saw little downtrend, little uptrend here. Now we've been in a significant downtrend. And even with the bounce that we were seeing, this chart hasn't adjusted for that. So even though we were bouncing, it's still treating things as more negative. And proper order, this is very similar to the chart that we just saw. All of these histograms are green. It produces like this big ramp here for Evel Knievel to jump off of. But Where you get the positive or negative is in the background. When we're going up, it's green. When we're going down, it's red. Well, we're still red here, and even with the bounce that we were seeing, this never did turn back over to green. So this is still remaining negative, meaning that we're in a downtrend. Another laundry indicator, laundry, is volatility. This is a newer indicator to me. I'm not really sure if we're getting a lot of insight here. It's just been giving us a lot of reading near the same levels. We've been flatlining here with a kind of a high reading. And the idea is that when we're going down, volatility gives us a high reading here. When we're going up, we get a low reading, but we're not really getting a lot of insight from this particular chart currently that we're not getting somewhere else. And this is the percent B indicator. This measures how far we are either above or below the upper or lower Bollinger Band. We're not there now, and so we're below the midpoint because we're below the midpoint of the Bollinger Band. So that's negative, but we're not getting any kind of an extreme reading now, so there's been no need to show this chart. Then we look at the S&P 500 on top and the S&P 100 on the bottom. Not really seeing anything too out of line with each other. We're just looking for divergences between the charts, and they're pretty much going more hand in hand with each other. A long-term rainbow going from 50 periods up to 250 periods, and we're below the rainbow. And we've been down here a while now, so we're starting to see some of the upper parts of the rainbow roll over. And if that continues, this would turn things more negative. This is also a chart that I talk about now every day in the videos, but I only show it in this video because we didn't get a signal for all of 2024. The last one was late 2023, and now we're getting one in 2025. This is the special K, which is a long-term oscillator. And when we're above the red line, that's positive. And then going in a few weeks back, we actually crossed below this line, and this is longer term negative. And we look at the weekly version of the S&P on top, the German DAX weekly chart here, and we see that their correlation is not strong right now. They're having a tendency to actually go in opposite directions as the S&P stocks in the US have been going down. In Germany, excuse me, in Germany, they've been going up. And so that's why we're seeing this correlation really dropping off currently. Then this is the Ichimoku cloud. We're well below this support level, which means we fell down below the cloud. So I haven't been showing this. There's also some studies on here. We have the short term, which is the green line, which is going down. And then when the blue line is below the red line, that's also negative. So this chart broke through support and is looking more negative currently. Some broad market measures. This is the VIXN, which is the volatility for the NASDAQ 100. I focus mostly on the S&P 500, so not as much on this chart. And then the QQQs, where we're falling below all the moving averages, and the moving averages are starting to come down. There's really been no need to show this chart because we're seeing this in the NASDAQ 100 indexes as well. If we come back up to the 200-day moving average, then I'll start showing this again. But since we're losing support and continuing to go down, it's just we're not necessarily getting any additional insight from this chart right now. We look at the S&P on top, and then we make kind of a pseudo growth to value ratio here. Growth would be the QQQs, the NASDAQ 100, and value would be the diamonds. That's the Dow. They're considered to be the best of the best stocks. And we can see that there's a pretty high correlation between them. Now, all of the indexes, the Qs and the diamonds, have been under pressure, but the Dow's been holding up a little bit better. And the reason for this pretty high correlation right now is that there's also value in the S&P. And so they've been more matched up with each other, not necessarily going in opposite directions. They're going in the same direction, which currently tends to be down. The Dow and then the transports. You see the red line, the transports, they're really underperforming the Dow. And even though they're on different scales, as a general rule, when the red line's above the black line, the transports are outperforming, and that's more positive. But the transports have really been having a difficult time, and they continue to underperform the Dow itself. We want to keep an eye on this. I watched the financial sector, and I use a chart of that in every daily video just to keep an eye on that area as a whole, because That's what fell apart going into the great financial crisis back in 2000, late 2007 into 2008. Well, it's been holding up and it's doing well. It's longer term, it's not necessarily outperforming the S&P, but it's in an uptrend lately, and it's been one of the better performing areas of the market. Well, an underperforming area of the market is the regional bank ETF. And so this chart takes a ratio of the regional banks to the financial sector, and we're seeing some weakness here. And so we want to keep an eye on that. This regional banking ETF, that means that it's underperforming, and does that mean there's more smaller banks that we're going to hear some bad news from, like Silicon Valley, Republic Bank, New York Community Bank? We just kind of keep that in the back of our mind at all times and go, okay, this is not performing all that well. Is that just normal market forces acting on this? Or is this actually trying to foretell that maybe there's going to be some problems with the smaller banks going forward? Rate of change, this is just for information. We're going down now. When we look at Friday's close and we go back 250 periods, it has been declining. It's still above the midpoint. It'll turn more negative if we drop below zero, but this is for a very long-term evaluation, and I just use this for information here. This is an area that I've been keeping an eye on because there's all these concerns out there, supposedly, that inflation is going to go up. Well, what's the market telling us? So we can look at a number of different charts here, and we look at the 1 to 3 month T-bill, which you could pretty much call a cash, and then we look at 3 to 7 year bonds. And as a general rule, when this is going up, that means there's uncertainty about interest rates and there's inflation worries. When it's going down, that means interest rates are usually coming down and inflation worries are subsiding. Well, we're coming down here and we're right down near the lower moving average right now. So this on a shorter term basis is showing that maybe the market's not having all that concern about inflation or interest rates right now. So that means that all this freaking out, at least on a short-term basis, maybe it's not justified. But then I look at other charts and try to come to that same conclusion. This is the TIPS, which they are Treasury inflation protected securities. They adjust for inflation. And when interest rates and inflation are going up, people want to get into those because they can ride the wave of interest rates and inflation actually going higher. When inflation is coming down and interest rates are coming down, then people prefer to be into 3 to 7 year bonds because you lock in an interest rate for 3 to 7 years at that point. Well, we're going back up a little bit here, but we're not really breaking to the upside with this particular ratio. So, yeah, there's some worries coming in. Some of this could be because in Friday's session, the core PCE was rounded up, and that's why the market decided to freak out and sell off in Friday's session. If we continue to see this going up and this ratio is in an uptrend, that means that the market is increasing their inflation fears. But it's really been chopping around. It's not really shown much conviction with this chart. Where we're seeing a little bit more conviction here is we look at TIPS again, and then we look further out at 7 to 10 year bonds. This had really been going up from the fall of 2024 into the beginning of 2025, and then it was really dropping off. Now it's starting to go back up a little bit. It did come down a bit on Friday, but we'll be watching this. If this continues to go up, that means that the market is now anticipating inflation fears instead of it just being talk out there that really doesn't have anything to back it up. We want to know how the market is reacting to interest rates and inflation, not necessarily what people are saying. Then we look at the long-term bond on top, that's in blue, and then the S&P, which here is in red, and we do a long-term correlation where we see they're actually the long-term correlation is actually weakening right now. They're not going in the same direction. They're having a tendency to go in opposite directions. And then we look at the short-term correlation based on 10 periods. It's turning back up, but it's just coming out of being neutral. And it's also suggesting that they're having a tendency to go in opposite directions. We do that same thing, but we look at the Qs instead of the S&P, although on this chart, the TLT is in red instead of blue. And we can see that they're having a fairly strong correlated opposite relationship, meaning that if the Qs are going up, that means bond prices are going down and vice versa. And that's pretty much what we've been seeing lately. And we look at the 10-year yield for the US and subtract the German 10-year yield. Since US rates are higher, we get a positive result. Then what's interesting is we can plot the result of this with the US dollar index, and there's a pretty high correlation between the two. And this is really what we want. This just means that nothing is really going crazy right now. This relationship is remaining normal. It's when it starts to really drop off. That's when we're thinking, okay, what's going on here? This isn't how it usually behaves. But for right now, it may not be pleasant that the market has been going down, but it doesn't look like anything is out of whack, at least according to this chart. When you look at the relationship between interest rates, both in the US and internationally, and then currencies, the dollar index. And we keep an eye on the 2-year yield. It had been dropping down. Sometimes when we spike up and come down, that can be positive for the S&P. Well, it's not really giving us much support currently. And another European versus US comparison, the Eurozone ETF and do a ratio with 3 to 7 year bonds. And the Eurozone, which is dominated by Germany, it's really been going up and it's still looking rather positive, even though it did drop off in Friday's session. But this just shows in another way that European stocks have been outperforming US stocks. Then I have these possible positive scenarios. I have another study that's the same thing, but I just set it up a little different, so I use a different chart. These are the percent of stocks in the S&P above their 200-day simple moving average. Now, how this chart is set up is we use it like an oscillator to get an extreme positive or negative reading. We're not getting one of those. Now, how we determine if this is positive or negative is it above or below 50? We're below 50 again. We started to get 50 back. We went above it. Then we lost it again, especially in Friday's session. So this chart is actually more negative. And the insight that we're getting from this chart, we're getting from the other chart that I do use. So I haven't been showing this chart. And we use that same basic approach here with those stocks above their 50 period moving average. We're also below 50, and that's negative. Look at the mid caps, also below 50 and getting an even lower score. And an even lower score are those small cap stocks above their 50 period moving average. So pretty negative right now. So thank you. I hope you found this helpful. I hope you have a great weekend, and I will talk to you in the next video.